So imagine you're running a retail business, right?
Okay, yeah.
You buy your inventory, you put it on the shelves, and you try to sell it for a profit.
That's the goal, obviously.
Right, that's the whole point.
Right.
But there is a catch, because every single day that a product just, sits on your shelf, it costs you money.
Yeah, it eats into your capital.
Exactly. It eats your capital.
Okay.
Now imagine that for the broader industry you operate in, a full third of everyone's inventory has been sitting on the shelves for over 4 months.
Oh, wow. Just collecting dust.
Just collecting dust, bleeding cash. And then, well, there's you. In just 6 months, you have somehow managed to clear out your backlog to the point where only 10% of your inventory is over 4 months old.
Right.
I mean, you are moving product while everyone else is completely freezing up.
Yeah, and that completely upends the traditional understanding of the market. Because when you look at the macroeconomic landscape of residential real estate right now, I mean, frozen is really the operative word.
It's totally frozen.
Yeah. Mortgage rates are just stubbornly hovering around that 7% mark. We have this massive lock-in effect, right? Where homeowners, they simply refuse to sell because, well, they do not want to give up that sweet 3% mortgage they secured back in 2021.
Right. Who would want to give that up?
Exactly.
Yeah.
So traditional transaction volume is just cratered. It's fallen off a cliff.
Ooh, welcome to this special Talk Tickers deep dive. Whether you are currently holding shares, maybe watching from the sidelines trying to time an entry point, or you're just simply trying to understand the bizarre mechanics of the current housing market, our mission here is to extract the signal from the noise for you.
That's right.
Because we are dedicated to breaking down corporate earnings calls for the everyday retail investor. And today we are taking on a massive one, Opendoor, trading under the ticker symbol OPEN.
A very interesting one right now.
Oh, absolutely. We have their Q1 2026 earnings transcript in front of us, and that covers the whole presentation and the entire Q&A session.
And just for some context here, this is a company attempting one of the most difficult financial pivots in recent tech history.
Yeah, in a terrible market.
Exactly. They're doing it in an incredibly unforgiving housing market. So my focus today is really going to be separating the narrative from the math. Executives, they love to talk about transformation, right?
They sure do. Always a big buzzword.
Right. But our job is to see if that transformation is actually showing up on the balance sheet and in their operational metrics.
Yeah, and that is the Talk Tickers mandate. We are data forward. We use plain language to just, cut through the Wall Street jargon. We take a definitive stance on the results, and we focus on what is actually actionable for your portfolio.
No vague summaries here.
Right, we do not do vague summaries. So Opendoor CEO, Kaz, he came into this Q1 call with a lot of swagger.
You really did.
Yeah, he laid out a case that Opendoor is fundamentally fixed. But before we get into the grand philosophies and the artificial intelligence integrations he kept talking about, I want to look at the cold, hard scoreboard.
Let's do it.
Like, did they make money and are they growing? Because if the core business is still shrinking, the philosophy is totally irrelevant.
Okay, let's unpack this.
So the headline numbers for the first quarter of 2026 are surprisingly robust, especially, when you contrast them with that national housing data we just talked about.
Right.
Let's start with the acquisition volume. In Q1, Opendoor officially purchased 2,474 homes.
Which is a massive jump. That represents a 45% increase from just the fourth quarter of last year.
Yeah, it's their second consecutive quarter of meaningful sequential growth in acquisitions. But, if we are looking for the leading indicator...
Right, the forward-looking stuff.
Exactly. The metric that tells us what next quarter is going to look like, we really need to look at signed contracts. And they signed contracts for over 5,000 homes in Q1.
Wow.
Yeah, that is their highest single quarter for signed contracts since, I think, the second quarter of 2022. Wait, I want to pause on the mechanics of that for a second, because why is there such a massive gap between the 2,474 homes they officially purchased and the 5,000 contracts they signed? Like, what does that timeline actually look like in the real world?
It really comes down to the friction of a real estate transaction. When a homeowner goes to the Opendoor website, types in their address, gets an offer, and clicks accept, well, that is a signed contract.
Okay, so that's the 5,000 number.
Right. But that doesn't mean Opendoor actually owns the house that exact day. The homeowner, they usually need time, right? They need to pack up their stuff. They need to close on their next house. They have to organize movers.
You can't just move out the next morning.
Exactly. So a contract signed in, say, mid-February might not actually close until early April. The homes Opendoor officially added to their balance sheet in Q1 were largely the result of contracts they signed way back in November and December.
Oh, that makes total sense. So those 5,000 plus contracts from Q1, those are effectively like a tidal wave of inventory that is going to hit their books in Q2.
Precisely. In fact, March alone was their highest single month for signed contracts in nearly 4 years.
That's huge.
It is. And their chief financial officer, Christy, she offered a really important nuance about this pipeline on the call. She explained that the funnel naturally narrows, They do not ultimately close on every single contract they sign.
Right, stuff happens.
Yeah, sometimes an inspection reveals a catastrophic foundation issue, or maybe a seller simply changes their mind and just backs out.
Sure.
But having a top-of-funnel volume of 5,000 contracts, that gives Opendoor an incredible luxury, which is the ability to be selective. They can actually afford to let the marginal risky homes just fall out of the funnel because they have so much volume behind it.
Right, but anyone with a giant pile of cash can go out and buy 5,000 houses, right? You just overpay for all of them.
True.
The actual business model is making a profit when you turn around and sell them. And that leads us to a metric we talk about constantly on this show, but it's uniquely critical for Opendoor, and that is resale contribution margin.
A very important one.
For Q1, they reported a resale contribution margin of 4.4%.
And the trajectory of that number is really the real story here. A 4.4% margin, that is an improvement of 3.4 percentage points compared to just the prior quarter.
Wow.
Yeah. And even more importantly, they expanded this specific margin for 6 consecutive months. If you look back at their charts, they hit an absolute floor in September of 2025. And every single month since that bottom, the margin has just steadily climbed.
We really need to define this clearly because, contribution margin is a term that gets thrown around in a lot of different industries, and it means something very specific in the context of flipping houses.
It does.
So what is the actual math happening behind that 4.4%? Like, what does it mean for the retail investor?
It is the absolute core of their unit economics. Contribution margin tells us whether the pure physical act of buying, holding, and selling a single house is actually generating cash or burning cash.
Yep.
Imagine a scenario where Opendoor buys a house in Atlanta for $300,000. The moment they own it, the meter starts running. They have holding costs, right?
Like property taxes.
Property taxes, homeowners association fees, water, electricity, and of course the interest on the debt they used to buy the house in the first place.
Right, that adds up.
It does. Then they have direct repair costs. Maybe they need to put in $10,000 for new carpets, fresh paint, maybe fixing a leaky roof.
And then there are the selling costs on the back end.
Yeah, exactly. When they go to sell that house, they usually have to pay a commission to the buyer's real estate agent. They have title fees, staging costs, closing costs. Let's say they finally sell the house for $330,000. The contribution margin is the percentage of revenue left over only after all of those specific direct costs associated with that one specific house are subtracted from the final sale price.
So it does not include corporate overhead, right? Doesn't include the CEO's salary or the cost of their AWS servers.
Correct. It is strictly the profit on the physical transaction. And for a significant period in their past, Opendoor was effectively running a negative contribution margin.
Which is terrible.
Yeah. They were paying so much to acquire the house, sinking so much into repairs, and holding it for so long that the eventual sale price didn't even cover those direct costs. So a 4.4% positive margin, it proves that the physical machinery of their business is actually fixed. They are buying homes at the right price, managing the repair costs efficiently, and selling them for a true unit profit.
Okay, well, I am looking at the next line item on the Q1 scorecard. And to me, this is where the turnaround actually becomes viable for the long term.
Well, the OPEX.
Yeah, let's talk about their operating expenses. These are the fixed costs, the corporate salaries, the software engineers, the office leases. In Q1, their fixed operating expenses were exactly $33 million. That is totally flat. It's actually down $2 million from the previous quarter and down $6 million year over year.
This is the textbook definition of operating leverage. And to understand how radical this is, you really have to look at their own historical data. The CFO pointed out that the last time Opendoor managed over 5,000 acquisition contracts in a single quarter, that was back in 2022.
Okay.
During that quarter in 2022, their fixed operating expenses were roughly double what they are today.
Double. Wow. So let's use a restaurant to visualize this for everyone listening.
Good idea.
Imagine you own a diner. Your fixed costs are the rent for the building, the salary for your one manager, and the lease on your ovens. Now, on a Tuesday night, you serve 50 tables, you make a little bit of money. But imagine on Friday night, you serve 100 tables.
Right, much busier.
You have doubled your revenue. But because you are so incredibly efficient, you didn't have to hire a second manager, you didn't have to expand the building, and you didn't need another oven. All of that extra revenue from Friday night just falls straight to your bottom line because your fixed costs stayed exactly the same. That is what Opendoor is doing right now. They are doubling the volume of homes moving through their system without adding any new corporate overhead.
And when you combine a positive contribution margin on the unit level with flat fixed expenses on the corporate level, well, you create an incredibly fast path to enterprise profitability. Because every additional house they push through that system drops that 4.4% margin directly to the bottom line simply because the fixed costs are already paid for.
Right. But, you cannot execute a strategy like this without a massive war chest. Buying 5,000 homes requires billions of dollars. Opendoor ended Q1 with $999 million in unrestricted cash.
Basically $1 billion.
Yeah, $1 billion sitting there ready to deploy, which is their highest cash balance in quite a long time.
The balance sheet is really structured to be both a safety net and an accelerator. The unrestricted cash, that's their liquidity. It ensures they can keep the lights on and weather any sudden shocks. But the real fuel for their business model is their debt facility. They currently have $7.1 billion in asset-backed borrowing capacity, and about $1.5 billion of that is already committed and drawn.
Talk to me about that term asset-backed. What does that mean for the risk profile of the company? Because seeing a company take on billions in debt, that usually makes retail investors incredibly nervous.
Yeah, and it's a critical distinction to make here. This is non-recourse, asset-backed debt.
Yeah.
That means the loans are secured directly by the individual houses, not by the corporate entity of Opendoor Technologies.
Oh, interesting.
Yeah. So if the housing market were to experience a catastrophic crash tomorrow and the value of a specific portfolio of homes plummeted below the value of the loan used to buy them, well, the lenders can take possession of those specific houses. But they cannot come after Opendoor's $1 billion in corporate cash.
Okay, so the liability is fenced off.
Exactly. It isolates the enterprise from localized or systemic real estate crashes. It allows them to scale their purchasing power to the tune of $7.1 billion without putting the entire company in existential peril with every single transaction.
Well, I am looking at all of this data, right? The margins improving, the contracts doubling, the fixed costs staying flat. And I have to admit, I find myself deeply skeptical.
Oh, really?
Not of the numbers themselves, but of the environment they are operating in. Like we mentioned at the top of the deep dive, mortgage rates are near 7%. Existing home sales nationwide are totally stagnant. Buyers are sidelined because of affordability issues, and sellers are sidelined because of that lock-in effect.
Right.
In a housing market where mortgage rates are sky high, how on earth is a company whose entire business model relies on buying and selling houses, managing to expand margins and double volume at the exact same time?
It is the paradox of this entire earnings call. I mean, it seems impossible. And the analysts on the call, they asked variations of this exact question. The answer from the CEO, Kaz, it hinges entirely on a structural, philosophical shift within the company.
Okay.
He spent a significant portion of his presentation detailing the transition from what he called Opendoor 1.0 to Opendoor 2.0. The turnaround in the numbers is a direct result of changing the fundamental operating system of the company.
And he was remarkably candid about this, too. You rarely hear a CEO speak this bluntly about how fundamentally broken their previous strategy was. He stated that the core fatal flaw of Opendoor 1.0 was that it operated like a proprietary trading desk at a Wall Street bank.
Yeah, let's break down what a prop desk actually does, because it really illuminates the mistake they made. A proprietary trading desk uses a firm's own money to make directional bets on the market.
Like gambling, almost.
Basically, yeah. They look at all the macroeconomic data, like inflation, employment, interest rates, and they place a massive wager on whether a specific asset is going to go up or down. Kaz admitted that the old Opendoor was doing exactly this with residential real estate. Everything they did flowed from one single question, which was, where will home prices be in 6 months?
Right. He said they were pushing billions of dollars onto the table based on an algorithm's guess about the future direction of the housing market. And, when that algorithm was right, they looked like absolute geniuses.
Sure.
But when the macroeconomic environment shifted unexpectedly, like when interest rates spiked at the fastest pace in modern history, they were caught entirely off guard.
Because when your entire business model is predicated on predicting the future, well, your natural reflex when the future becomes uncertain is to play defense. When the market started cooling down, the old Opendoor panicked. They widened their fee spreads.
What does that mean, practically?
That means instead of charging a seller a 5% fee, they might charge 8 or 9%, effectively lowering the cash offer they made for the home. They did this to build a larger buffer against falling prices.
But Kaz explained how that defensive move triggered a massive unintended consequence. It created a death spiral. By widening the spreads and offering less competitive prices, they fundamentally changed the demographic of the seller who would actually accept their offer.
Exactly.
Think about it. A homeowner with a beautiful, well-maintained house in a highly desirable neighborhood, they are not going to accept a lowball offer. They will just list it traditionally. The only people who accept a lowball offer with a massive fee spread are desperate sellers, often with homes that have structural issues or homes in undesirable locations.
Right. It is a classic adverse selection problem. By trying to protect their margins with wider spreads, they ended up acquiring a portfolio of much lower quality homes. And lower quality homes take significantly longer to fix and significantly longer to sell.
And the clock is ticking the whole time.
Exactly.
Yeah.
The longer a home sits, the more the holding costs eat into the profit. So their margins plummeted. And because their margins plummeted, their pricing algorithm saw that the business was struggling, and it automatically widened the spreads even further to compensate.
Oh man, it is a terrifying feedback loop. Every defensive action they took made the underlying problem worse. Kaz used an incredible phrase on the call. He said they were playing prevent defense when they were down by a touchdown. The entire corporate culture defaulted to a defensive posture.
And that leads us to the core of Opendoor 2.0. They didn't just tweak the algorithm, they threw out the entire underlying premise. They realized that predicting the macroeconomic future is impossible. So they stopped trying. They shifted their entire operational model from acting like a prop desk to acting like a market maker.
Now, this is a massive conceptual leap. What is the difference in execution between a prop desk betting on direction and a market maker?
Well, a market maker does not care if an asset's price is going up, down, or sideways. A market maker makes money by providing liquidity. They facilitate the transaction, they offer a price to buy and a price to sell, and they capture the tiny spread in between.
Just skimming the spread.
Right. And the key to being a successful market maker is volume and, crucially, velocity.
Velocity. That was the absolute central theme of this earnings call. Kaz was literally wearing a t-shirt on the video stream that just said, faster.
Yeah, because for a market maker, time equals risk. If you hold an asset for a long time, you are exposed to the risk that the market might crash while you hold it. If you move the asset instantly, you eliminate that risk entirely. So if a market maker senses volatility or danger in the broader market, they don't slow down and widen spreads like a prop desk.
They speed up.
They do the exact opposite, yes. They speed up, they lower their margins slightly to ensure the asset clears their books as fast as physically possible.
The faster you move a house off your balance sheet, the less any single macroeconomic event can hurt you. And they rebuilt the entire company around this concept. Kaz called it their Velocity OS.
Right, their operating system.
He said they brought in a completely new team of operators, high-frequency thinkers, signal intelligence officers from hedge funds, logistics experts. Their only mandate is to optimize the physical and digital pipeline for pure speed.
And, to see if this philosophy is actually working, we have to look at a very specific metric, which is inventory health, specifically the percentage of aged inventory. This measures how many of the homes Opendoor currently owns have been sitting on the market unsold for more than 120 days.
This is the stat I alluded to at the very beginning of the deep dive. The transformation here is just staggering. Let's look at the timeline. At the end of the third quarter of 2025, an incredible 51% of Opendoor's inventory was over 120 days old.
That's massive.
More than half of the houses they owned were just sitting there, stagnant, racking up property taxes and interest costs.
It was a massive anchor weighing down the entire balance sheet.
But by the end of Q1 2026, that number plummeted to 10%. They went from 51% aged inventory to 10% in the span of just 2 quarters.
And to truly contextualize how impressive that is, you have to look at what the rest of the housing market was doing during that exact same 6-month period. Back in Q3, the broader U.S. housing market average for homes sitting over 120 days was 23%.
Okay.
But by the end of Q1, because high mortgage rates had effectively paralyzed buyers, the national average had climbed to 33%.
So the rest of the country got older, slower, and more stagnant, while Opendoor became incredibly lean and fast.
Exactly. What's fascinating here is how they completely changed their relationship with risk.
Yeah.
By moving faster, less capital is tied up, reducing their exposure to sudden housing market crashes. They're carrying a portfolio of homes that is materially fresher than the national average. That is the velocity OS functioning in the real world. They're pricing homes aggressively to move them quickly, rather than holding out for absolute top dollar.
But, implementing a velocity OS is easy to say on a whiteboard. Executing it in the physical world of real estate is incredibly difficult. Houses are not digital tokens, they are physical objects. They have leaky pipes, strange floor plans, bad school districts, emotional buyers. Moving that fast requires massive operational efficiency. And this is where management introduced the most dangerous buzzword in corporate America right now.
Yes. Artificial intelligence.
AI.
It is a dangerous buzzword. We see it in nearly every transcript we analyze. Companies mention AI simply to capture algorithmic trading bots and boost their stock price, often with no underlying substance at all. But Opendoor's presentation was different. They did not talk about generic generative AI or basic chatbots. They presented highly specific operational use cases where AI is directly altering their unit economics.
Yeah, and Christy, the CFO, she addressed the skepticism directly. She made a point to say that while other companies are blowing their budgets trying to climb AI token leaderboards, Opendoor is focused strictly on measurable impact. She even mentioned they have an internal Slack channel literally called Default to AI, where teams are mandated to share automated solutions.
Let's examine a few of those specific tools they deployed because it explains how they achieved that velocity. The first one they highlighted is an AI pricing underwriter they call Noah. This system is now actively pricing standard homes in their Phoenix market.
Now, how does an algorithm price a physical house better than a human real estate agent who has lived in Phoenix for 20 years?
It really comes down to data ingestion at scale. A human agent might know that, say, a house near a specific intersection usually sells for less because of highway noise. But Noah can ingest millions of data points across thousands of micro neighborhoods simultaneously.
Oh, wow.
Yeah, it analyzes historical transaction data, permitting data, school district boundary changes, and even hyperlocal traffic patterns. By replacing human guesswork with algorithmic precision, they can generate a highly accurate initial offer almost instantaneously, which speeds up the entire acquisition process.
Okay, so pricing is one thing, but they also talked about an AI audit tool for home inspections. This is where it gets really granular. When Opendoor buys a house, they send a human inspector out to look at it. The inspector writes up a massive PDF report detailing every crack in the driveway, every old water heater, every stained carpet. In the past, a human project manager at Opendoor had to read that massive report and make subjective decisions about what to fix and what to ignore.
Which is incredibly slow and prone to human error or inconsistency.
Right.
One project manager might decide to replace all the carpets, while another might just decide to deep clean them.
Right. So Opendoor built a computer vision and natural language processing tool that automatically ingests the inspector's photos and text. It reconciles that raw data against Opendoor's historical repair database. It knows mathematically whether replacing a carpet in that specific zip code will yield a higher return on investment than just cleaning it. It removes the human subjectivity.
And the financial result of that tool is significant. Management stated this AI audit process cut wasteful renovation spending by 10 to 20% per home in their pilot market.
That's huge.
Yeah, if you're saving 20% on your repair budget, that cash goes directly into expanding that 4.4% contribution margin.
But the example that truly blew my mind was their title intake process. For anyone who hasn't bought a house, the title process is a nightmare.
It's awful.
It is mountains of complex legal paperwork designed to prove that the person selling the house actually owns it and that there are no hidden liens against the property. Opendoor stated that the process of intaking and verifying title paperwork used to take up to 5 hours of manual human labor per transaction.
You had paralegals or title officers sitting at desks, physically reading through dense, archaic legal documents page by page.
Using large language models and optical character recognition, Opendoor has reduced that 5-hour process to exactly 15 minutes.
15 minutes. Unbelievable.
The AI instantly reads the documents, verifies the signatures, cross-references the property descriptions, and flags any anomalies for a human to review. It automates the mundane, repetitive reading, allowing the humans to only focus on the exceptions.
And during the Q&A, an analyst asked Kaz about this broader AI strategy, and he offered a very sophisticated framework. He said the lazy approach to AI is simply using it to do the exact same broken processes, just slightly cheaper. That's just basic automation. But the real transformational leverage, he argued, is using AI to take a blank piece of paper and completely rebuild the process from scratch.
He emphasized that real estate is messy. It's atoms, not bits. Most software companies in Silicon Valley want to build pure SaaS products. They want to avoid the messy, physical reality of the world. Kaz said that Opendoor views that physical complexity as their moat. They aren't trying to eliminate the complexity. They're using AI to navigate it so efficiently that it becomes invisible to the consumer.
And this leads to his ultimate philosophical point about AI and real estate, which is dissolving information asymmetry.
What does he mean by that?
The entire traditional real estate industry, the brokers, the agents, the title companies, they all make their profit precisely because a real estate transaction is complex and frightening for the average person.
Right, it's intimidating.
Exactly. The industry relies on the fact that you do not know how to file a deed or negotiate an inspection contingency. They act as gatekeepers, charging massive commissions, usually 5 or 6% of the home's value, to navigate that friction for you. Kaz is arguing that Opendoor can use AI to build digital concierge services that provide the exact same level of hyperlocal expertise and guidance as a human agent sitting at your kitchen table, but at a fraction of the cost.
Which brings us to another major piece of their operational shift. If they are acting as a market maker, providing liquidity and removing friction, they need products that actually appeal to sellers in a frozen market. In Section 2 of the presentation, they highlighted a relatively new product offering called Cash Down, More Later. I found this fascinating because it completely breaks the mold of their traditional business model.
It really addresses a fundamental psychological barrier for sellers. The classic Opendoor 1.0 model was a rigid take-it-or-leave-it proposition. They made a cash offer. It was usually slightly below market value, but it offered certainty and speed. The problem is, many sellers look at that offer and think, well, I love the certainty, but what if my house is actually worth $20,000 more on the open market? I don't want to leave money on the table.
So they hesitate, or they walk away and go with a traditional agent.
Exactly. The Cash Down, More Later product is an elegant solution to that hesitation. It works like this. Opendoor gives the seller an immediate cash advance, a baseline amount that is guaranteed. This allows the seller to unlock their equity, move out, and go buy their next house without waiting. But then, Opendoor lists the vacant house on the open market.
They act almost like a broker in this scenario.
Essentially, yes. Opendoor does the repairs, stages the home, and manages the showings. When the home finally sells to a third-party buyer, if it sells for more than that initial cash advance plus Opendoor's fee, the original seller gets the upside.
That is brilliant. It completely shifts the risk dynamic.
It does. It provides the seller with the absolute certainty of an immediate cash floor, which solves their liquidity problem, while still allowing them to participate in the upside of the open market. For Opendoor, it requires less upfront capital, reduces their balance sheet risk, and expands their total addressable market to include sellers who would never accept a standard cash offer. It's a perfect example of how moving from a rigid prop desk mentality to a flexible, customer-centric market maker model opens up new avenues for acquisition.
Okay, so I have listened to the philosophy, the market maker pivot, the AI efficiency, the new product lines. It sounds incredible. But my job here is to represent the skeptical retail investor.
Of course.
I have to play devil's advocate. I have to push back because human nature is human nature. If management commands a team of high-frequency thinkers to double their acquisition contracts and operate on a velocity OS, the easiest way to hit those speed targets is to just get sloppy. Moving fast usually means getting sloppy.
You are suggesting they are loosening their underwriting standards just to inflate the top-line numbers.
Well, I am suggesting that if my boss tells me to buy houses twice as fast, I might start ignoring the fact that a house is located right next to a noisy freight train line. Or I might casually overlook a slightly sagging roof. Are they just buying any house they see, including ones with bad foundations, just to juice their acquisition numbers?
It is the most critical risk factor when a company suddenly re-accelerates growth like this. The analysts on the call hammered them on this exact point. Kaz acknowledged that during the Opendoor 1.0 days, there was a persistent myth in the real estate industry that Opendoor was the buyer of last resort, the company that would blindly buy the house with a cracked foundation that no one else wanted.
And he denied that is happening now.
He categorically denied it. And more importantly, he didn't just ask investors to trust him. He pointed directly to the data, specifically the cohort curves in the text.
Let's define what a cohort curve is so everyone can visualize the proof.
A cohort is simply a group of homes that Opendoor purchased in a specific time period, usually a single month. During the presentation, management displayed a chart tracking the performance of these different monthly cohorts. The horizontal x-axis tracked time, specifically the percentage of homes in that cohort that had been sold. The vertical y-axis tracked the profit margin of those homes.
Okay, so a line going from left to right shows us how the profit margin changes as they slowly sell off the homes they bought in a given month.
Exactly. Kaz first showed the old Opendoor 1.0 cohorts on the chart. They were represented by purple lines. As you followed those purple lines from left to right, as time went on and they tried to sell those older homes, the lines plummeted downwards. The margin collapsed. It proved that the longer they held those old homes, the more money they lost. They were structurally flawed acquisitions.
But then he overlaid the new Opendoor 2.0 cohorts, the homes they acquired using the new pricing algorithms in October, November, December, and January.
Those were represented by blue lines. And the visual contrast was striking. The blue lines are practically horizontal. The profit margin does not degrade over time the way it used to. Let's look at the specific data for the October cohort. They have successfully sold through over 80% of the homes they bought in October. From the moment they bought them to the moment they sold the 80th percentile, the margin only dropped by 90 basis points.
Just to keep our terms strictly defined for everyone listening, a basis point is simply 1/100%. So 100 basis points is exactly 1%. When you say the margin dropped by 90 basis points, you mean it only decreased by 0.9% over the entire selling period.
Correct. It is an incredibly small degradation. To put that into perspective, management noted that a year prior, that exact same journey, selling through 80% of a cohort, would cost them over 260 basis points, or 2.6%, in margin degradation.
That is almost a 3 times improvement in margin stability.
It proves, mathematically, that they are not getting sloppy. The homes they are buying under this new Velocity OS are holding their intrinsic value better, requiring fewer unexpected repairs and selling much closer to their initial predicted price. Management stated on the call that the new cohorts, specifically October through January, show the best combination of margin stability and resale velocity in company history, excluding the weird COVID anomaly.
So the data confirms they are buying better homes faster. We have looked at the Q1 scoreboard, we've dissected the pivot from a prop desk to a market maker, and we have verified the underwriting discipline. But knowing that the strategy is working today is really only half the equation for an investor.
Oh, absolutely.
The stock market is forward-looking. It prices a company based on what management promises to deliver tomorrow. So let's transition to the third section of our analysis, management guidance. What exactly are they projecting for the future?
They laid out aggressive targets that suggest this turnaround is really accelerating. Let's start with the immediate future. For the upcoming second quarter, Q2, they are projecting revenue to grow approximately 25% quarter over quarter.
That is a massive sequential leap. That is the direct result of those 5,000 signed contracts finally closing and turning into actual inventory they can sell.
Exactly. The pipeline is flushing through. But, volume without profit is meaningless, which brings us to their guidance on that critical contribution margin metric. They guided for Q2 contribution margin to hit right in the middle of their 5% to 7% goal.
So they are expecting it to climb from the current 4.4% right into that sweet spot. That is significant.
And it leads directly to the most important metric for any growth stage technology company, profitability. For years, the narrative around Opendoor was that it was a structural cash incinerator.
Right.
But Christie, the CFO, explicitly guided that they expect Q2 adjusted EBITDA to be completely break even.
Let's define adjusted EBITDA for anyone who doesn't spend their days staring at income statements.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a metric used to evaluate a company's pure operational performance by stripping out the cost of debt, tax burdens, and accounting rules regarding depreciation. The adjusted part means they're also stripping out non-cash expenses, the most common one being stock-based compensation given to employees.
So it is essentially a proxy for the actual cash being generated or burned by the core day-to-day operations of buying and selling houses.
Yes. Hitting break-even adjusted EBITDA means the core engine of the company is finally self-sustaining. It's no longer bleeding cash to operate. And Kaz did not stop there. He reiterated a massive long-term promise. Opendoor expects to be adjusted net income profitable on a trailing 12-month go-forward basis by the end of 2026.
Okay, here's where it gets really interesting, but also where I start to get a little bit nervous again. Promising enterprise profitability by the end of 2026 is a bold flag to plant. The housing market is currently terrible. The only way most traditional real estate companies see a path to profitability is if the Federal Reserve steps in and slashes interest rates back down to 4 or 5%, which would theoretically unfreeze the market. Are Kaz and Opendoor secretly just banking on a macroeconomic bailout from Jerome Powell to hit these targets?
An analyst asked a very similar question, challenging the realism of that 2026 profitability goal, given the stubbornness of high interest rates. And Kez's response was perhaps the most defining moment of the entire call. He used a famous analogy from Warren Buffett. Buffett famously said, "You only find out who is swimming naked when the tide goes out."
Meaning easy money hides bad business models, and hard times expose them.
Precisely. Kaz stated that in the residential real estate sector right now, the tide is aggressively, undeniably out. Most real estate CEOs are spending their earnings calls complaining about the macro environment, wishing the tide would come back in. But Kaz told investors that he knew the tide was out when he accepted the role of CEO. He didn't take the job hoping the environment would miraculously improve to save his tenure.
He used the phrase sunshine patriots. He said he wasn't looking to build a team of people who only know how to operate when conditions are perfect.
He explicitly said, "We choose hard mode because that is what makes us stronger. We do not need permission from the Fed to put on our shorts to go swimming."
We do not need permission from the Fed to put on our shorts. I love that quote. It is a direct public declaration that their profitability targets are not contingent on a broader housing market recovery. They explicitly stated they do not need the Federal Reserve to cut interest rates, nor do they need the macro housing market to recover to hit these profitability goals.
He is establishing a baseline. He is telling the market that their internal models, their guidance, and their path to profitability assume that this brutal high interest rate environment continues exactly as it is today. If the Federal Reserve does eventually cut rates, or if the lock-in effect thaws and inventory floods the market, they view that as pure upside. It would just act as the tailwind. But they have built a machine designed to win in a hurricane.
Part of winning in that hurricane involves expanding their revenue streams beyond just the physical house flip. They need to capture more of the economics surrounding the transaction, and the biggest swing they are taking in that regard is the rollout of Opendoor Mortgage.
We have to analyze this carefully because on the surface, it looks incredibly risky. During the Q&A, an analyst brought up promotion. Opendoor is currently running in the state of Colorado, where they are offering buyers a 4.99% mortgage rate.
Right.
As we discussed, the national average for a 30-year fixed mortgage is hovering near 7%. Banks are not lending money at 5% right now because it doesn't make financial sense given the cost of capital. So when I saw Opendoor offering a 4.99% rate, my immediate assumption was that this is a desperate loss leader marketing gimmick. They must be taking a massive loss on the mortgage just to lure a buyer in so they can unload the house.
That is exactly what the analyst implied, and Kaz was visibly defensive about the word promotion or gimmick. He stated firmly, "We don't run rate gimmicks here. We charge what the math allows us to charge." He insists that offering a rate 200 basis points, or a full 2%, below the national average is not a subsidized loss. He claims it is a permanent structural cost advantage derived from their technology. It's a key future growth driver.
Explain the math on that to me, because how can a tech company originate a loan that much cheaper than JQ Morgan or Wells Fargo? It requires looking at the structural bloat of the traditional mortgage industry. Kaz explained that a standard legacy lender typically captures about 340 basis points, or 3.4% of the loan value, in revenue. That is the margin they need to operate. But what are they actually spending that 3.4% on?
It's overhead.
Massive overhead. Kaz referred to it as a toil tax imposed on the consumer. That 3.4% margin pays for physical bank branches in prime real estate locations on Main Street. It pays for massive, multi-million-dollar national television advertising campaigns. Crucially, it pays exorbitant commissions to an army of human loan officers who essentially act as salespeople. And it pays for human underwriters to manually shuffle physical paper back and forth.
And Opendoor has none of that legacy infrastructure.
Yes, exactly. Opendoor built a digitally native, AI-driven mortgage platform from scratch. They do not have physical branches. They do not have a commissioned sales force. The loan is integrated directly into the digital checkout process when you buy the home on their app. And they use software to automate the vast majority of the underwriting and document verification. Because their internal operational cost to originate a loan is fundamentally structurally lower than a traditional bank, they don't have to keep that 3.4% margin. They can compress their margin and pass the savings directly to the consumer in the form of a lower interest rate.
So they are still making a profit on the loan, but they are using their technological efficiency to undercut the market on price. Kaz mentioned they are consistently running about 100 basis points, or 1 full percent, below the market average on a daily basis. That translates to a 10 to 15% cheaper monthly payment for the buyer. That is a massive competitive advantage when affordability is the #1 issue for buyers right now.
And they are aggressive about scaling it. They are currently operational in a handful of states, but they are in flight on licensing in 20 additional states and expect to double their geographic footprint for Opendoor Mortgage by the end of the third quarter.
Okay, this all sounds incredibly cohesive. The narrative is strong. But as retail investors, we have all been burned by charismatic CEOs painting beautiful pictures on earnings calls. Management loves to make promises. How does a retail investor listening to this at home know they aren't just selling us a dream? Management teams are exceptionally good at highlighting the positive data and hiding the structural flaws. They talk about AI dominance and structural advantages, and then 3 quarters later, the stock drops 40% because of some unforeseen macroeconomic headwind. How do we hold them accountable?
It is a profound point. Kaz actually acknowledged this inherent skepticism during the call. He even made a self-deprecating joke about being a fan of the Toronto Maple Leafs hockey team, saying he knows intimately what it feels like to be promised hope and greatness at the beginning of every season, only to be handed crushing disappointment in May.
So he understands that investors have deal fatigue with turnaround stories.
He does. And what's fascinating and frankly highly unusual for a public company's CEO is that he didn't just ask for blind trust. He proactively gave analysts and investors the exact framework to judge his performance. He literally gave investors the exact 3 metrics to hold them accountable to. He explicitly said, "I'm going to tell you what it would look like if we were losing."
What are the 3 markers?
First, the cohort curve slopes we discussed earlier. If those flat blue lines start degrading and dropping sharply like the old purple lines did, it means their underwriting has gotten sloppy and they are failing. Second, acquisition volume. If their signed contracts stall out, plateau, or drop to the low end of their projected guidance range, it means their market maker model isn't scaling and they are failing. And third, inventory health. If that crucial metric of homes sitting over 120 days creeps back up from 10% towards the 20 or 30% range, it means their velocity OS is broken and they are failing. If those regress, management admits they are failing.
He didn't just give the metrics. He pointed people to where they can find the data. He mentioned a public website, accountable.opendoor.com, where anyone can track these specific KPIs on a weekly basis. He literally invited the market to watch the scoreboard in real time.
It is a move that signals supreme internal confidence. You do not publicly define the exact parameters of your own failure unless you are absolutely certain that the operational machine you have built is structurally sound. They believe the transition to Opendoor 2.0 is complete, and they are willing to show their math.
Which brings us to the final section of our Talk Tickers deep dive. The bottom line, synthesizing all the data, the story, and the guidance into a definitive stance for you, the Talk Tickers listener. We have examined the Q1 scorecard, noting the massive jump in contracts and the expanding contribution margins. We have dissected the philosophical pivot from a directional prop desk to a velocity-driven market maker. We have explored how AI is physically altering their cost structure, and we've looked at their bold guidance for profitability in hard mode.
This raises an important question.
Are we bullish or bearish on Opendoor going forward?
When you synthesize all the data points from this transcript, I have to take a firmly bullish stance on the Q1 results and the immediate operational trajectory of the company. A turnaround is no longer just a narrative concept for Opendoor. It is mathematically visible in the financial results. Opendoor has proven that its market maker, velocity-first model, can generate positive contribution margins and dramatically freshen its inventory even when national housing data is sluggish. They are demonstrating true operating leverage by keeping fixed costs completely flat, despite pushing massive new volume through the system.
They have decoupled themselves from the macro environment.
Exactly. They have proven that their high-velocity model can generate positive cash flow on a unit basis, even when the national housing market is completely frozen by high interest rates.
For our Talk Tickers audience, here is your actionable advice. If you hold the stock or are considering it, ignore the national headlines about mortgage rates, ignore the panic about the Federal Reserve dot plots, ignore the monthly reports on existing home sales, and ignore the daily fluctuations of the 30-year fixed mortgage rate. Opendoor has demonstrated that those macro wins are no longer the primary driver of their survival.
Your focus should be laser targeted on internal execution, specifically their upcoming Q2 earnings report.
Yes. Focus purely on Opendoor's Q2 earnings to see if they actually hit that 5-7% contribution margin and achieve adjusted EBITDA break-even. If they hit those specific markers, the machine is truly fixed. So what does this all mean? It means Opendoor is no longer a macroeconomic bet, it's an execution story.
I completely agree with that assessment. The risk profile has fundamentally shifted from macro risk to execution risk.
As we wrap up this deep dive, the overarching narrative of Opendoor's Q1 2026 is defined by a massive operational shift towards speed, flat operational costs, and a much healthier inventory book. They abandoned the hubris of trying to predict the future of home prices. They adopted a philosophy of velocity, using AI not as a gimmick, but as a tool to ruthlessly eliminate friction and physical holding costs.
But before we sign off, there's one final, incredibly compelling concept we need to explore.
Right.
It happened at the very end of the Q&A session. An analyst asked a seemingly throwaway question about the future of real estate technology, specifically using the phrase tokenization of real estate. Kaz, who clearly has a deep, almost philosophical passion for this subject, took the question and went on a fascinating tangent about the archaic nature of the global financial system.
He went incredibly deep into the history of commerce. He talked about the evolution of money, moving from bartering goats to standardizing coinage, to the invention of paper checks, and finally to the creation of the SWIFT banking system. And then he pointed out a terrifying reality. The trillions of dollars moving through the global banking system today are still largely running on COBOL, a programming language created in 1959.
The foundational software of global finance is older than the Apollo moon landing. His core argument was that all of these historical systems, from 1959 banking code all the way back to the medieval English tradition of proving you own a piece of land by handing someone a literal clod of dirt in front of witnesses, they all share one fatal flaw. They all rely on human intermediaries. You need a banker, a notary, or a title officer to verify the transaction and update the ledger.
And every human intermediary extracts a fee and adds time to the process. Kaz argued that blockchain technology, or what he prefers to call on-chain settlement, represents the first time in the history of human commerce where two parties can exchange massive value securely without needing a middleman's permission or verification. He hinted at putting real estate titles, escrow, and mortgages on-chain to remove human intermediaries.
He targeted the title insurance industry specifically. He pointed out the absurdity of the current system. A house is the most expensive, important asset the average human will ever purchase. And yet the proof of ownership for that asset relies on disparate, often messy paper records sitting in filing cabinets in county courthouses across the country. We pay billions of dollars a year to title companies just to have humans manually search those paper records to ensure someone else doesn't secretly own the house.
Kaz envisions a future where the physical reality of a house is tethered to a digital token. He wants to see real estate titles, escrow accounts, and the mortgages themselves all put on chain on a public, immutable ledger. By doing this, you completely eliminate the need for human title searchers, human escrow agents, and the massive multi-thousand-dollar fees that go with them. He explicitly noted Opendoor's recent acquisition of Doma's escrow division as the first foundational step toward building what he called checkout for real estate, a one-click, instant transaction.
Which fundamentally changes how we must view the long-term potential of this company.
Exactly. I want to leave you, the listener, with this final provocative thought to mull over. Right now, Wall Street evaluates Opendoor as a house flipper. The math is based on how many houses they can buy and sell in a quarter. We look at their total addressable market, their TAM, as the roughly 40 million Americans who decide to move every year. But if Kaz's ultimate vision comes to fruition, if Opendoor transitions from just flipping houses faster to actually building the underlying blockchain and financial infrastructure that powers all U.S. real estate transactions, if their technology becomes the digital rails for title, escrow, and settlement for every single home bought and sold in America, regardless of whether Opendoor is the buyer or the seller, does their total addressable market change from just people who want to move to the entire multi-trillion-dollar U.S. housing economy?
It is a complete paradigm shift. It elevates them from being a participant in the market to being the actual exchange upon which the market operates.
We started this hour looking at a company trying to survive a frozen housing market. It turns out Opendoor isn't just trying to figure out how to sell houses in a bad market. They are trying to rewrite the fundamental code of how a house is transacted. Thank you for joining us on this special Talk Tickers deep dive. Keep looking past the corporate jargon, stay relentlessly focused on those numbers, and we will see you next time.